Chapter 2, Part 2.
Income and employment effects. In the conventional theory of income determination, government either creates employment by hiring people or buying goods or services, supplies income, Social Security, or spends on services for people, Medicare and Medicaid. Government also takes income from people by taxes and fees. When the government hires someone, a useful service is presumably provided. Similarly, when the government purchases something from, say, a defense contractor, something useful is presumably produced. On the other hand, when the government transfers income to people, there is no direct effect on employment and output. Nothing that is presumably useful is exchanged for the income, and the economic impact comes only as the recipient spends the funds that are transferred. In the standard view of how government affects the economy, government spending on goods and services is considered a component of aggregate demand, along with consumption and investment. But government transfer payments are not. The rules governing consumption spending are expressed as a function of disposable income, various measures of wealth or net worth, and the payoff from using income to acquire financial assets, such as interest rates. Transfer payments, as well as Social Security taxes and personal income taxes, enter into the analysis indirectly by the way of disposable income and its effect on consumer spending. Because of the way matters are measured, the impact of GNP on $1 spent to hire leaf rakers in the public parks is greater than $1 given in welfare or unemployment benefits. In 1975, the government distributed some $18 billion in Social Security payments. If 50% of the amount paid on Social Security had been spent on wages for the aged in a variety of work programs, then GNP would have been higher by some $40 billion. It is clearly a normative, economic, and sociological question whether it is better for a country to provide income for the aged through jobs, either in private industry or in make-work projects, or to provide income through transfer payments. It should also be noted that military spending constitutes part of GNP. The distinction between transfer payments, taxes, and government spending on goods and services in the calculation of GNP is valid if, and in truth, only if, we divorce the measure of GNP from any welfare connotation and treat it purely as an output measure that is transformed into a current period demand for labor, into employment. Government purchases of goods, such as a bomb or paper clips, and of services, whether of a general, private soldier, a senator, or an engineer, are related to employment directly, as workers are hired and goods or services are produced. They are also related to employment indirectly through consumers' disposable income, as the employed workers, business managers, and profit receivers spend on consumption and investment goods. Transfer payments also affect employment indirectly, as they provide additional disposable income for households and additional gross profits for business. Thus, the simple, straightforward way in which government affects employment is an important part of the picture. Government spending, especially in excess of taxes, is a determinant of income. In terms of spending, the big increase over the post-war era has been in transfer payments to persons and grants in aid to state and local governments, as shown in Table 2.2. In 1950, early in the post-World War II era, total federal government spending was $40.8 billion, some 14% of GNP. $10.8 billion, about 25% of government spending, was transfer payments to persons. In sharp contrast, in 1975, total federal government spending was $356.9 billion, some 24% of GNP. Transfer payments were $146.1 billion, or 40% of the total government spending. The other government programs that have grown rapidly are the grants in aid to state and local governments. These grew from $2.3 billion in 1950 to $54.2 billion in 1975, from 5 to 15% of government spending. There are differences between the ways various major components of government spending developed over the longer haul of 1950 to 69 and the 7 years of ostensibly conservative government under Presidents Richard Nixon and Gerald Ford. Between 1950 and 69, total government purchases of goods and services increased by a factor of 5, the national defense component rose by a factor of 5.45, and the civilian government function rose by a factor of 4.51. Over this same period, transfer payments to individuals also increased by a factor of almost 5. Thus, in the period when relatively liberal administrations dominated Washington, government purchases of goods and services and transfer payments to persons increased at about the same rate. In contrast, between 1969 and 1975, federal government purchases of goods and services rose 26%, with national defense spending increasing 10% and the other civilian function rising 85%, but transfer payments to persons scored nearly 200%. In 1975, they were almost 20% greater than government purchases of goods and services, compared with 1950 and 69 when they were very much less. Transfer payments consist of a large array of entitlement programs. As such, they tend to increase automatically whenever the economy enters a recession. In addition, because they are programs already in existence, it is relatively easy for Congress and any administration to increase their generosity as the economy enters a recession. Although unemployment rates went to 8.9% in May 1975, in no quarter during 1973 to 75 did disposable personal income decline. One reason was the way transfer payments by government exploded. Between the first quarter of 73 and the fourth quarter of 75, disposable personal income increased by $247.8 billion, and government transfer payments increased by $65.2 billion. 26.3% of the rise in disposable personal income was accounted for by transfer payments. As a percentage of disposable personal income, they stood at 12.69% in the first quarter of 1973, peaked at 15.96% in the third quarter of 1975, and retreated to 15.72% in the last quarter of 1975. As a result of the explosive growth of transfer payments in 1975, almost 1 out of every $6 that households had to spend or had spent for them on consumption was a result of a federal or state program that granted this income or service independently of current work performed. As a case in point, unemployment insurance, which was at a $5.3 billion annual rate in the second quarter of 1974, rose to a $19.4 billion annual rate during the second quarter of 1975. Such a dramatic rise in unemployment insurance payments helps to explain why the sharp downturn was reversed so quickly. I will ignore questions that must be raised about the efficiency and equity of an economy in which 1/6 of total disposable income is the result of entitlement programs. The existence of a large, increasing proportion of disposable income that is independent of employment or of the profitability of businesses is beneficial, for it sustains demand and thus prevents a very deep and sustained fall of the economy during a recession. On the other hand, the existence of such programs, combined with a tendency to expand their scope when the economy is in recession, is harmful, for they impart an inflationary bias to the economy. The increase in disposable income, even as output and employment decreased in 1973-75, is one reason prices kept on rising throughout the recession. Transfer payments, which provide income without work, set floors to money wage rates. Each improvement in transfer payment schemes has the effect of raising the price at which some people will enter the labor market. The effective productive capacity of the economy is eroded by decreasing labor force participation when price-deflated transfer payment schemes are improved, especially if, as is our practice, eligibility depends on being either unemployed or out of the labor force. Cash flow effects of big government. A fundamental proposition in economics is that the sum of realized financial surpluses and deficits over all units must equal 0. This follows from the simple point that every time some unit pays money for the purchase of current output, some other unit receives money. Because the different sectors of the economy, households, business firms, government, and financial institutions, are consolidations of elementary units, this proposition also holds for the various aggregations. If the federal government spends $73.4 billion more than it collects in taxes, as it did in 1975, then the sum of the surpluses and deficits over all other sectors equals $73.4 billion surplus. As is shown in Table 2.4 for annual data and Table 2.5 for quarterly data in 1973 to 75, the sum of the surpluses and deficits of the various behavioral and accounting sectors was 0, within small margins due to data imperfections. The household surplus or deficit is the difference between disposable personal income and personal outlays. Almost always, except in deep depressions, and then only in an economy with a small government, households generate a surplus. But this surplus as a percentage of household disposable income varies quite markedly. Table 2.4 shows that household saving ran from 6.08% of disposable income in 1972 to 8% in 1973, 7.5% in 1974, and 8.9% in 1975. In both 1973 and 75, the household saving ratio increased sharply. Each jump in the household saving ratio is associated with a jump in the deficit of some other subdivision of the economy. In 1973, the jumping deficit was that of business. In 1975, it was the government's deficit that jumped. Private investment is undertaken by the business sector. The business sector deficit is the excess of plant and equipment, inventory, and corporate housing investment over business internal funds, retained earnings plus capital consumption allowances. This deficit was $47.9 billion in 1972, jumped to $79 billion in 73, remained high at $67 billion in 1974, and fell sharply to $21.5 billion in 1975. The business deficit, as a percentage of gross private investment, rose from 26.7% in 1972 to 35.8% and 32.4% in 1973 and 74 respectively, and then fell to 10.9% in 1975. The path of the deficit in total government, federal, state, and local, showed a $10 billion swing in both 1973 and 74, a decrease in 73 but an increase in 74, and a $60 billion increase in 75. The $60 billion increase in 75 must show up either as a decrease in the deficits or an increase in the surplus of other sectors. Part of it appeared in a $15.6 billion increase in household saving, which led to the household saving ratio being 8.92% of personal disposable income. Another part showed up in the huge increase of $33.1 billion in business gross internal funds, a rise of some 23%. In 1975, the year of a major increase in unemployment and a sharp decrease in price-deflated GNP, gross business profits increased by 23.4%. Another component that offset the rise in government deficit was a fall of some $13.2 billion in investment, mainly the result of inventory liquidation. The $60 billion rise in the total government deficit was thus offset by a $15.6 billion rise in personal saving and a $46.3 billion decrease in the business sector deficit. In 1975, the government deficit, therefore, was mainly offset by a rise in corporate cash flows. Business profits, correctly defined, were sustained and increased even as the economy was in a severe recession. The data for the first quarter of 1973 to the third quarter of 75 serve to emphasize how a major increase in the government deficit is associated with a movement toward surplus by other sectors of the economy. Gross internal funds of the business sector ranged in the narrow band of 134 to 147 billion in the 8 quarters of 1973 to 74. No discernible trend was evident during this time. However, in the first 3 quarters of 75, gross internal funds of business measured 154, 171, and 185 billion dollars. Between the third quarter of 1974 and the third quarter of 1975, business gross internal funds rose by 36% in spite of the fall in national income and employment. The federal government deficit was at an annual rate of $102 billion in the second quarter of 75. This deficit was $94 billion greater than the deficit in the second quarter of 74, so there had to be a $94 billion swing in other sectors' surpluses or deficits in order to offset this massive change. This swing was broken down as follows. Household personal saving rose by $40.7 billion, business gross internal funds increased by $28 billion, and investment fell by $30 billion. Of the total swing, some $40 billion was reflected in personal saving, and some $60 billion was reflected in an increase in business internal funds or in a decrease in business investment. Both the annual and quarterly data showed that even as the economy plunged into a deep recession, the gross internal funds accruing to business increased. In the American economy, business is carried on within a system of borrowing and lending based on margins of safety. 2 measures of the margin of safety are the ratio of the cash flows due on debt to the cash flow debtors receive, and the ratio of the present value of expected cash flows discounted over the future to the face value of outstanding debts. The boom of the 1970s and the longer-run evolution of the economy over the post-war era were associated with a large increase in short-term debt issues by business and a proliferation of financial institutions that finance such debt by issuing their own, usually short-term obligations. The major determinant of the quantity of such short-term debt that business can carry is the internal funds that are generated by operations. In the absence of big government and the huge deficit that automatic and discretionary policy combined to generate in 1975, a plunge of the economy, as it occurred in 74-75, would have been associated with a plunge in corporate cash flows. Business debt-carrying capacity and the margins of safety in the system of borrowing and lending would have decreased. Even in the absence of actual bankruptcies, such decreases in business cash flows would have forced efforts by business to contract commitments. In fact, government gross profitability increased in 75, so that a forced or induced curtailment of commitments did not take place. In 1975, the impact of big government by way of the massive deficit it generated was critical in breaking the decline and quickly reversing the recession into an expansion. The full import of government as a preventer of cumulative declines and as a sustainer of economic activity cannot be appreciated without recognizing the significance of the proposition that the sum of the surpluses and deficits over all sectors must equal 0. The efficiency of big government can be questioned, but its efficacy in preventing the sky from falling cannot be doubted. The above examination is based on accounting identities, which do not incorporate any behavioral relations. A mere presentation of accounting identities is not a theory and does not lead to any causal inferences. In order to understand what happened, we must look at how the end result is achieved, how the sectoral surpluses and deficits, when summed over all sectors, equal 0. We must therefore formulate ideas about what are the determining and what are the determined items in the accounting tables, introduce assumptions on how the economy actually works, so the end result is always achieved. To a considerable extent, household personal outlays are responsive to changes in income. This passive household saving and consumption behavior is attenuated by the existence of both household wealth and consumer debt. Some 40 years ago, when John Maynard Keynes first formulated his theory in terms of passive consumption behavior, household wealth and consumer installment credit were a much smaller part of the total economic picture than in the 1970s. The large household saving ratios of 74 and 75, which were referred to earlier, were in good part a reflection of the collapse of automobile sales. Part of the increase in household saving in 1974-75 took the form of a reduction in household borrowing to finance automobile and other purchases. If a pause takes place in the rate at which consumer credit is extended, even as disposable income is sustained or increased, then the saving ratio will be high, as in 1975, and an improvement in the liquidity position of households will take place. With a lag, this accumulation of household liquidity will lead to a jump in consumer spending. Those households that have not been strongly and directly affected by unemployment during a recession tend to increase the ratio of spending to disposable income once an accumulation of liquid assets and a decrease of debt relative to income take place. As a result of this impatience to spend, a recession with a high savings ratio, such as that of 1975, is followed out by recovery in which the saving ratio is low. When the ratio of saving out of disposable income falls, the consumer becomes a hero in leading the economy out of a recession. The heroism of the consumer, however, is a lagged response to the high saving ratio of the recession. The observed variability in the ratio of saving to disposable income is evidence that consumer behavior is not fully passive. Nevertheless, the relation between consumer spending and present and past developments in the economy is fairly well known and relatively stable. We know that personal outlays will almost always lie between 95 and 91% of personal disposable income. Furthermore, if the savings ratio is high, toward the 8 to 9% range for a time, then it will soon be followed by a burst of spending that lowers it toward 6%. The household saving entry in tables 2.4 and 2.5 is therefore largely determined by how the system is operating and how it has operated in the recent past, as is the entry for government revenue. Congress, the state legislatures, and various local authorities pass laws that set tax schedules. As a result, the amount collected in taxes, given any set of tax laws, depends on the behavior of the economy. On the other hand, the two items in the tables that vary quite independently of how the economy is currently functioning, and hence are the determining or causal factors in what happens, are business investment and government spending. Business investment is largely, if not completely, determined by today's views on the future. Of course, the past and present behavior of the economy, which will help set current views about tomorrow, affects both the scale of the facilities that will be built and the way in which these facilities will be financed. What bankers and businessmen think today about revenues and out-of-pocket costs over the next 25 years and more basically determines whether and at what terms financing for long-life projects will be forthcoming. Investment, rather than being currently or historically determined, is based upon views about the future. The other item in Table 2.5 that is largely independent of the current operation of the economy is government spending, which is submerged in the government deficit or surplus side of the table. Spending programs that largely consist of the purchase of goods and services are set in the budget and are, with minor limitations, determined by congressional actions. Another component of government spending, which is covered by the rubric of transfer payments, is similar to taxes in that legislation, together with administrative regulations, sets up formulas for entitlement. The actual expenditures determine on the behavior and economic position of various households. As a consequence of these dependent and independent relations, a fall in income due to a decline in investment spending or a rise in the consumer saving ratio will lead to a rise in takings from entitlement programs and a fall in government tax receipts. Combined with the program of discretionary government spending and tax changes, this will lead to a large increase in the government deficit. This deficit must be offset by an equal move towards surplus by the business and household sectors. As the move towards surplus on the part of the business sector leads to an increase in business gross profits after taxes, an increase in the debt-carrying capacity of the business sector takes place even as the economy moves into a recession. Furthermore, a large household saving ratio will be induced by the government deficit. This implies that, with a lag, there will be an autonomous rise in consumer spending. This autonomous rise will take place after the downward movement of the economy has been halted and after the high saving ratio has led to both a decrease in household debt relative to income and a rise in household holdings of liquid assets. In the absence of a large government sector in 1975, two downward processes would have been started. First, private investment would have fallen even more than it did because of further inventory liquidation and a decrease in, if not abandonment of, investment programs already in process. Second, disposable personal income would have fallen faster, even faster than personal outlays, so that the household sector saving ratio would have been smaller. That is, in the absence of big government, an initial retrenchment of investment would have triggered downward movements. Decreases in business inventory investment and household disposable income would have been part of a cumulative process. Both consumption expenditures and investment expenditures decrease in an effort by the economy to eliminate a virtual excess of savings, surplus, over investment, deficits. However, the fall in household spending and business investment decreases the flow of business internal funds, which tends to increase the business deficit for any level of investment. A cumulative interactive decline in household income, household spending, business investment, and business cash flows is likely to occur. This, of course, is the interactive process that leads to deep depressions. Big government, with its potential for automatic massive deficits, puts a high floor under an economy's potential downward spiral. Although this high floor is important in itself, it is particularly important in a world with business and household debt because corporate gross profits and household savings are essential to validate such debt. Without the emergence of a huge government deficit in 1975, the debt-carrying capacity of business and households would have been severely compromised. Such compromising, due to an iterative, downward spiral of income and profits, led to the debt deflations and deep depressions of the past. The sectoral budget impact of big government that sustains business profits is precisely what makes such a cumulative, interactive decline impossible. Balance sheet implications. Financial instruments are absorbed or created whenever big government runs a surplus or a deficit. In particular, whenever big government generates a huge deficit during a recession, other sectors, including financial organizations such as banks, savings banks, and insurance companies, acquire the government debt issued to finance the deficit. We live in an economy with a complex financial system. In this system, the surplus sectors, in 1975 it was households, are not required to acquire directly the liabilities of deficit units. Instead, they can finance these deficits indirectly by acquiring liabilities of financial institutions. In our economy, banks, savings institutions, insurance companies, and pension funds, among other institutions, are likely to be the immediate owners of the debts of business, government, and households. Households acquire the liabilities of financial institutions such as pension rights, insurance policy, cash surrender values, demand deposits, and various types of saving or time deposits. Consequently, much of the direct impact of swings in deficits and surpluses among sectors will be on the assets acquired and sold by financial institutions. Wide swings in the placement of government debt between several financial and non-financial sectors took place during recent years. Table 2.6 shows the total acquisition of government debt, treasury and agency issues combined, by private domestic sectors between 1972 and 75. The acquisition of government debt by government bodies, such as the Federal Reserve System, government agencies, and government-sponsored agencies, and by foreigners, has been subtracted from the total issued to derive private domestic acquisition. In 1972, 73, and 74, the total acquisition of government debt by private sectors showed only modest changes, although the totals rose a bit each year. In 1972, the major purchasing sectors were financial institutions. Commercial banks, savings and loan associations, and mutual savings banks acquired $12.2 billion of government debt. In 1973 and 74, however, the major acquiring units were in the non-financial sector, in particular households. In 1973, households acquired $20 billion of government debt, so that all the other private domestic sectors combined decreased their holdings by some $2 billion. In 1974, households acquired $14.5 billion, and non-financial business acquired $3 billion. In 1974, there was a net acquisition of government debt by the financial sector, largely by the mortgage-related savings and loan associations. This acquisition by savings and loan associations reflected the emerging decline in housing. In 1975, the pattern of net acquisition of government debt changed markedly from that of previous years. In this year, the non-financial sectors acquired some $20 billion of government debt, as in 1973 and 74. But, in sharp contrast, the holdings of households decreased, while those of non-financial corporations increased by $16 billion. Also, state and local government holdings rose sharply. However, the big change that occurred was in the amount acquired by the financial sectors. These sectors obtained some $57 billion of government debt in 1975, $50 billion more than in 1974. Of the $50 billion increase, $30 billion was acquired by commercial banks and $11 billion by savings and loan associations. The huge acquisition of government debt by commercial banks and other financial organizations thus financed the government deficit, and in the process, the balance sheets of the acquiring organizations were markedly changed. Government debt is free of default risk. Whatever the government debt contract says will be forthcoming will, in fact, be forthcoming. This contract is in nominal terms. Price level changes can and do affect the purchasing power of government debt. Furthermore, government debt is marketable, and its marketability is ultimately guaranteed by the Federal Reserve System, a guarantee that does not necessarily extend to other debt. Thus, the owners of government securities are assured of the ability to modify their portfolio as their needs or preferences change. In a sense, by acquiring government debt in 1975, banks, savings and loan associations, life insurance companies, and pension funds were able to store financing power. They were able to shift it from the time of slack private demand to some future period when private financing demand is strong. The inflationary potential of a massive deficit such as the one that occurred in 1975 is not felt fully during the time of the deficit. Rather, it occurs largely in the subsequent boom when the assets acquired during the recession are undone. Table 2.7 exhibits the net acquisition of various financial assets by the commercial banking sector for the years 1972 to 75. A striking change is evident in the amounts acquired over these years. In 1972, the commercial banking sector obtained $78 billion in financial assets. Although in 1973 acquisitions increased to in excess of $100 billion, during 1974 they tapered off to $84 billion. In 1975 they were a relatively modest $33 billion. The commercial banking sector was a driving, determining factor in the economy during 1972 to 73, but a passive, acquiescing one in 1975. Another striking change across the period 1972 to 75 was the composition of the assets acquired by banks. In 1973, some $52 billion, or more than 50% of the net assets, were bank loans not elsewhere classified, NEC, such as bank loans to businesses. Commercial banks also acquired $19.8 billion of mortgage and $10.6 billion of consumer credit in 1973. It is evident that the banking sector was deploying its financial resources toward the private sectors. The sharp recession year of 1975, however, stands in stark contrast to what happened in 1973. Not only did commercial banking acquire only $32.9 billion of financial assets in 1975, but $30.3 billion of the assets acquired were U.S. government debt. Bank loans NEC decreased by $12.9 billion, and consumer credit went down fractionally by $0.6 billion. Also, mortgage acquisition fell to $3.1 billion. All in all, in 1975, bank resources were being deployed away from business and toward government. One implication of the large increase in government debt and deficits that occurred during the recession year of 1975 is that various businesses and financial institutions were able to acquire safe and secure assets, which improved the liquidity of portfolios even as aggregate income and employment fell. A reduction in private business indebtedness could take place while banks increased their total assets and total liabilities. When government had been small and the outstanding debt not large, a sizable increase in government debt held in various private portfolios, including the portfolios of banks, could not take place during a recession. In these circumstances, a decrease in private business debt necessarily meant a decrease in demand and time deposits. A cumulative interactive decline in business debt and the public's holding of demand and time deposits did not occur in 1975 because there was the large and increasing volume of public debt outstanding that could enter the portfolios of banks and business. In 1975, because of big government and the large increase in government debt, the default risk of business and bank portfolios decreased. As businesses liquidated inventories, they decreased their indebtedness to banks and acquired government debt. Banks and other financial institutions acquired liquidity by buying government debt rather than by decreasing their assets and liabilities. The public, both households and business, not only acquired safe assets in the form of bank deposits and savings deposits, but were able to decrease their indebtedness relative to income. The existence of a large and increasing government debt thus acted as a significant stabilizer of portfolios during the threatening period of 1975.